Hello and good morning, everyone. I'd like to welcome everyone onto this planning for the tax year end event this morning. It's great to see so many attending. So if anyone has any technical issues, feel free to contact us using the chat function. And we will be holding a question and answer session towards the end of the event. So please feel free to post your questions as we go through in the Q&A box, and we'll pick these up and address these later. Also on the panel this morning, we've got Jack Bennett, who's on the way to being a chartered tax advisor, and he works on our tax team. So first of all, as everyone is no doubt aware, the tax year in the UK finishes on the 5th of April, which is actually just 42 days away from now, so not too far away. But I don't know if anyone else has ever wondered why the UK had a rather odd year-end date of 5th of April. It's kind of quite an unusual day, isn't it? Anyway, I decided to a bit intrigued, so I looked it up, but it's actually quite rare compared to other countries in the world as to having a 5th of April year-end. And apparently the reasons for it actually date right back to the Middle Ages, believe it or not, when apparently the tax year used to begin on a particular religious festival day. And then in 1752, it was moved to the 5th of April. And then because of some challenges with leap years and everything, it ended up being starting on the 6th of April. And it's basically from about 1800 onwards, it's been like it is. So it ends on the 5th of April and starts on the 6th. So anyway, it looks like we're sort of stuck with it for the moment, but that's where it all came from, apparently. So anyway, the purpose of today's event is to think about the actions you need to think about and consider before the end of the tax year, so before the end of the 5th of April. Now, we're not really talking about corporation tax so much in this event, because that more is dependent on when your financial year end is of the company, if you're in a limited company. But this is really talking about more the personal income, personal tax side of taxes. And I guess just before we kick off, just to be clear, obviously what we're covering today is general in nature, and we can't stress enough that you must take your own personal, professional tax advice, speaking to your accountant on your circumstances. So first off, the first bit we're going to cover off today is looking at how we're going to maximize some of the tax allowances that are available to us. So hand over to Jack for that.
Thanks, Angus. I think it's always important when approaching the end of either a tax year or your financial year, just to step back and review what actions you need to take in order to ensure you're using all the tax allowances available to you, and especially those that can't be carried forward into future years. So I should really just mention that the main focus of this first few points is in relation to shareholders and directors of a limited company structure. And really, the first place to start is with your 0% tax allowances. So as you can see, every individual has a personal allowance of £12,570 and a dividend allowance of £2,000 based on the current year. And these are taxable at 0%. So you might say as a minimum, we want to use that for as many people as possible so that they get that tax free. Then, as you can see, we can look to then use the individual's basic rate band. So you take their income to just over £50,000. And due to lower dividend tax rates, you can see that on this example, a shareholder can receive just over £50,000 and only pay about £2,700 personal tax. Now, even if you don't require the funds in that year, we still recommend, profits permitting, you declare that dividend for the full amount, because this will just build up your loan account and means you can draw down tax-free in the future. So this might seem quite basic, and in many ways it is, but the fundamental point is you need to make sure you maximize this every year, because otherwise you lose that allowance. And firstly, maximize it for yourself, then look at maximizing it for your spouse or partner, so you get their allowance as well. And then you can also look at other options for using these 0% allowances or lower tax rate bands for other families, such as children or grandchildren. Now, many on this call will already be aware of Family Wellbeing Trust, which enables companies to use these 0% tax allowances for children or other family members to cover costs like private education, future house deposits, apartment rent, or even just to build up their savings. Now, another question that often arises in relation to personal tax at year end is interest received on loans. So a company can pay interest on loans provided by the shareholders or directors, as long as there is a formal loan agreement in place. So you've got to have that loan agreement in place, and you've got to charge a fair market rate of interest. The interest is then tax deductible for your company, so it goes against corporation tax profits, and it can be tax-free in the hand of the shareholder. So just to cover off how it's taxed in the hands of the shareholder, you've got two allowances you need to look at. So you've got your personal savings allowance. So this is a tax-free allowance for interest income, which attracts a 0% tax rate. So if you're a basic rate taxpayer, so that's income up to £50,270, as we saw on the previous slide, your personal saving allowance is £1,000. That then reduces to £500 for higher rate taxpayers and is not available for additional rate taxpayers, so they get £0 allowance. Then you can also look at the starting rate for savings, which gives, again, tax-free interest income, but it's up to £5,000 as long as your other income is less than that figure there of £17,570. Now, the key point to note is that other income does not include dividend income. So in a typical scenario, we see very often directors will be on a small salary of in the region of £9,500 per annum. Now, that is significantly below that £17,570. So they would actually be able to access the full £5,000 starting rate for savings. So once you combine the two of them, that means that directors could be able to receive savings income of up to £6,000 per annum, tax-free for them and tax deductible for their company. So it's a win-win situation. Now, the key action I would take away from this is that if you're not already, it'd be worth considering setting up loan agreements so that you can charge interest on your director's loan account. Interest will then be declared on an annual or a quarterly basis and be included within your income for that year. Then just turning to inheritance tax, there are some very worthwhile allowances here which allow you to pass on small elements of your estate to family and friends over a period of several years. Now, for context, the default situation is that any gifts made personally would remain within an individual's estate for 7 years for inheritance tax purposes, and that is attracting a potential tax liability of 40%. So by using these allowances, you can make sure that these gifts are not included within your estate, and you can give money to the next generation or to other family. So firstly, you've got the annual exemption there, which allows you to gift up to £3,000 per tax year. And this can be a single gift to one person or a number of gifts to various individuals. And to note, this is not relating to gifts to charity. I'm talking about gifts to individuals here. You can also carry forward this allowance for up to 1 year. So if you didn't use last year's annual exemption, you could gift up to £6,000 in the current tax year. So as a real life example, for a couple that haven't used last year's annual exemption, they could gift up to £12,000 before the 5th of April, and that would be excluded from their taxable estate for inheritance tax. Inheritance tax relief is also provided for gifts for weddings or civil partnerships. So that allows a tax-free gift of up to £5,000 per child, £2,500 for a grandchild or great-grandchild, or £1,000 to any other person in each tax year. And you can also combine this with the annual exemption above. So in the event that your child was getting married, you could combine the £5,000 with the £3,000 and give them a gift of £8,000 in the current tax year. Then the final inheritance tax relief to cover off on is the small gift allowance. And this allows you to give as many gifts of up to £250 per person as you want, as long as you haven't used any other inheritance tax allowances for that person during the year. So you couldn't give them £3,000 annual exemption plus the £250. You can't use both of them. Now, there are a number of other allowances that can be relevant to some, and they're shown on this screen, such as marriage allowance or enterprise investment scheme. Now, this is more niche, you might say. It's more tailored to you as an individual to suit your circumstance. So you'd require really further discussion about your personal circumstances to advise whether these are relevant. So hopefully that's covered off on how we maximise the tax allowance we've got. Does that help, Angus?
Yeah, thanks, Jack. I think it's good just to realise all the different allowances that there are available to us. And, you know, I guess we often think about our sort of basic tax, income tax side of things, but the inheritance tax bit as well is interesting and quite pertinent, really. So there are those allowances that roll on every year, and it's a question about how we are utilising those. So, and like you said, once they're gone for this year, that they're gone, if you like. You can't necessarily get them again. So good. So I think the next section we wanted just to cover off was on relation to some other actions, you might say, other options to consider before the end of the tax year. And the first one was in relation to charitable donations. So we're talking about personal charitable donations here, which many will refer to as gift aid donations. So many will be aware that if you make donations to a registered charity, then obviously as an individual, that is a monetary benefit to the charity because they can reclaim gift aid, but it can also be a tax benefit personally. Now, this is only really applicable in terms of the actual tax benefit to you personally, where you've got more significant personal income. So, i.e. you're into those higher rates of tax. So on the screen that Jack mentioned earlier, with that about that 50,000 mark, if you're earning, you know, if your total income is over that, then the personal gift aid really kicks in, and there's some extra tax benefit to be had as an individual. And I think the point about discussing it now, before the end of the tax year, is that any donations you make to a registered charity, which are eligible for gift aid, can help reduce your tax in this tax year. So if it's relevant to you, it may be worth looking at. However, there will be some on this call, in our clients as well, where they may be operating in quite a well-run and tax-efficient company structure. Now, in that case, normally speaking, the donations are best made out of the limited company to the charity, and the company gets a tax deduction against its profits. And that's normally the best and most efficient way of doing it, because if we remember back to Jack's slide previously, where we've got the income that's only taking us up to the 50,000 maximising allowances, if we're not going above that and not paying high rates of tax, then there is no real benefit to us personally to do those donations like that. So it's best done out of the company. So that's just to make that clear. But I think if you are making any donations, in any case, personally, and I guess there's those ad hoc ones, isn't there, to various charities that come up, just make sure you capture them all. Make sure you just keep a record, make sure you keep a list, so that we can make sure you get your tax benefits back if there are some to had. And also, there's things like the sort of Just Giving and GoFundMe pages, that kind of thing. If they're set up to be fundraising for a charity, sometimes they're eligible for gift aid. So again, they can count. Just a question of keeping your records on that. And also, just, I guess most will be aware, but there are some sort of museums and attractions and that kind of thing where you can actually choose to donate your ticket fee and actually make that a gift aid donation. I think I'm right in saying that Blenheim Palace might be one of them as an example. So yeah, it's just those sort of things just to be aware of. Make sure you keep a record of them. So that's charitable donations. So that's one thing we need to consider. The second one I wanted to discuss today was in relation to pension contributions. So again, the actual tax relief in this context, in terms of personal pension contributions, works in a very similar way to the gift aid and the charity donation. So it's only really applicable if you are, over those sort of £50,000 per person markers to your total income. And then personal pension contributions could be something to think about. And I think we would say that if you haven't got a personal pension, and particularly if you're kind of the more senior generation, then it might be something worth looking at. And as I said, to be clear, we're talking about individual pension contributions. Now, there will be some clients on the call today where we would have helped implement their own family pension fund trust, which would quite often sit alongside the company structure. And in that case, it's usually about making the contributions out of the company. So it's a slightly different scenario in those situations. We're really talking about here, if you're getting those earnings, as we said, over 50,000, then we can look at doing some pension contributions before 5th of April, and that could save you some tax. Now, with pensions, just to very quickly mention, there are certain annual allowances, again, which are available. We won't go into all the detail of them today, but it is one of those very few allowances which you can carry forward for up to 4 years, actually, and that can actually be quite beneficial in the future. So I think the message probably on this webinar today is to think about, if you've got a pension fund, speak to your accountant, and is it worth making any personal pension contributions? Would there be any tax benefit in doing so? Or if you haven't, and you kind of, as we said, of the more senior generation, you may want to consider setting one up, registering one before the 5th of April, and maybe just contributing maybe £100 just to kind of kick it off. And then what happens then, as soon as you kind of kicked it off and actually contributed, is that then those carry forward allowances will start rolling on. So they don't apply if you haven't got a pension fund or made any pension contributions, so you can't get any carry forwards from prior years. So that's it's probably quite a specialist area, so you probably will need some tax advice on it, but that is just a recommendation we're mentioning today. Now, the other thing, point to note about these donations and charity donations and the pension contribution is employees. No, don't forget employees. So again, we're talking about those employees that maybe are earning more than 50,000 PAYE, or got total income of that amount or more. And this is actually quite important, because if you are in that situation, or you have employees in that situation, to get the additional tax relief on donations that they make, or pension contributions, and that includes obviously the auto enrolment pension contributions, they will not get that tax relief automatically on the higher rate tax. So we see this quite a bit as some missed opportunities here. So you need to make sure that, or employees need to make sure they inform HMRC of what donations and pension contributions they've made, or fill in a tax return and make sure that they get the tax benefit out of doing that. And just an example on this, we were speaking to a potential client just the other day. He actually worked for a large software firm and was earning good money, over £250,000 PAYE per year. We were just helping on a tax project to help him on his private school fees, actually. But it was just out of a conversation, just talking to him, he just didn't realise that he wasn't getting the best benefit out of his pension contributions, just doing through auto enrolment, which obviously could have been quite significant in his case. So I think that's just to bear in mind. Does that make sense, Jack?
Yeah, thanks, Angus. That's good. Some good actions to take away from that. I also just wanted to cover off on capital gains tax, and really the consideration needs to be given in relation to the timing of any capital gains tax liabilities. So this is gains on disposal of capital assets such as property or shares, and there's really two aspects to consider. Firstly, by delaying any capital disposal but to the 6th of April 2022, you're then giving yourself a further 12 months before the tax liability becomes due. So to explain, if you made a disposal on the 5th of April 2022, the tax liability would be due by January 2023. If you made that same disposal the next day, so the 6th of April 2022 instead, the tax won't actually be payable until January 2024. So you're giving yourself an extra 12 months to pay the tax. It's worth mentioning, however, that it's currently fairly uncertain what will happen to capital gains tax rates or availability in the future. There has been quite a bit of ongoing speculation for some time that there will be some changes brought in. So deferring any capital gain does carry some risk that the rates or the allowances could change in the meantime. The second point is to consider whether you're making the best use of your annual exempt allowances. So as you can see on the screen, each person has an annual exempt allowance of £12,300 for capital gains during any tax year. Now, as an example, we're currently working on a project with a client where they're looking to sell some of their shares. And by selling some of their shares on 5th of April and some after the 5th of April, you're then allowing two lots of annual exempt allowances to be offset against the gain. And you're also deferring some of the tax payment. But it is important that you take professional advice about your specific situation on this, however, as this isn't always a recommended or available solution for all capital gains. So hopefully that's given a few ideas. We've covered off on quite a few tax saving options before 5th of April. I just really want to move on and cover off on a few further changes that come into play from April 2022 in particular. So firstly, obviously many will be aware the Health and Social Care Levy was introduced last year, comes into effect from April 2022. And this is a 1.25% rise on dividend tax and national insurance rates. And then from April 23 onwards, it will be introduced as a separate levy, but it will still apply. Now, in many ways, it's coming into play. There's not too much you can do about it. But a couple of considerations might be just to think about any significant bonuses that you would typically pay in April that could be paid in March instead. So just by way of an example, your company might typically pay a bonus of £20,000–30,000 to various employees in April. If you were to choose to pay this in March instead, it'd give a 1.25% saving to the employees, and then also a 1.25% saving to the employer. Now, in reality, because of the low percentage, it's not likely to realise huge tax savings, but it might be worth some consideration. The other point to consider relates more to the dividend tax rates, which are increasing by the same 1.25%. And in some situations, it could be worth considering increasing the dividends you pay in the current tax year. So the typical example I'm thinking of is where perhaps a shareholder's loan accounts are running quite low. You're anticipating some additional drawings needed over the next 6 to 12 months. So have a look at whether it's worth increasing your income from £50,270 that we set out earlier up to £100,000 per individual for the current tax year before these dividend tax rates increase. And I would also just make sure that you're keeping close to your employees at this time. Obviously, they will be suffering this 1.25% increase in national insurance. When you combine that with higher interest rates coming in, higher inflation rates at the moment, and quite significant increase in living costs, this will put pressure on a number of households. So I think it's important you make sure you're discussing this with your employees, letting them know, making sure they're aware of what impact it'll have on them. And then from your business point of view, make sure you're budgeting for the increase in national insurance costs, and then also some potential salary increases where appropriate to help out your employees. I don't know if you think that would be good, Angus.
Yeah, it's good, Jack. It's just quite key, isn't it, at the moment with all that's going on, that we are aware and aligned with challenges of employees, and we just need to make sure that we're sort of supporting our employees and making sure that we're factoring in those extra costs, like you say, in the budgets. So that's good to get a change, get grips with the changes that are coming in from April from a tax perspective. There is just one other smaller point, but it could be relevant in relation to MTD, which is making tax digital. That's taking effect from April. So I guess everyone probably remembers about 2.5 years ago, HMRC went live with making tax digital for VAT. So since April 19, businesses above the 85,000 turnover threshold have needed to submit their VAT returns digitally. However, for those that have been below that threshold, even if they have been registered for VAT, they haven't needed to do that. So I think in simple terms, that's what's changing from April, is that all VAT registered businesses, regardless of the income or turnover, will need to register for MTD and submit their VAT returns digitally. Now, obviously that will affect sole traders and some smaller businesses in that category, and it's key to ensure that a MTD compliant accounting system is set up, which can be done relatively simply and could obviously bring some benefits to you. But I guess there's probably a number on the call as well thinking that, oh, my turnover is obviously higher than £85,000. But I think the point about bringing it up today is it's important that you review all of your entities in your structure. So things like holding companies, maybe other separate subsidiaries, other companies, maybe even a partnership that you've got, maybe even a pension, like we talked about before, family pension fund. If they are registered for VAT, then you will need to make sure they are registered for MTD, so making tax digital, by April, and that you have got some compliant system to actually submit your VAT returns digitally. So that's just it's a small and technical point, but it is actually quite important to look at that. So just to round up before we go on to the Q&As, obviously, as we've said, there's not many days left until the end of the tax year. So you need to review what options are relevant to you, as we've covered off this morning. And it's key that you, as we've said before, take advice as to what you can do, what applies in your situation, so you can proactively minimize tax where you can. Now, just on this vein, our next event, there is going to be a spring statement, which is going to be announced by the Chancellor on the 23rd of March. So that's going to be 23rd of March, Wednesday, which will be on the back of a revised economic forecast as well. So we'll have we're going to hold this event on the 4 o'clock on the Wednesday afternoon, and we'll be covering off on the main announcements that have been made in the Chancellor's statement. And we'll also be discussing kind of what's come out in the economic forecasts and how that changes, and also discussing some ideas and as to how we can navigate through the challenges that are facing some businesses at the moment, with the obviously rising costs, inflation, interest rates, and just look at opportunities that are out there to be had out the current situation. So stay tuned for that. We'll be sending around the email following this event with a link to register for that event on the 23rd of March at 4 p.m. So just in summary, key takeaways before we move on to the Q&A, question and answers. As Jack mentioned, we want to be utilising all of our current year tax allowances where relevant. Make sure you look at them all, make sure you consider what you can do to utilise those. Number two is obviously looking at your pension contributions and charity donations, if it's relevant to you before the 5th of April. Still chance yet to look at that. As Jack mentioned around the capital gains tax, if there is any upcoming disposals on that side of things, again, you may want to just take some advice on that as to how to best structure that. If you obviously are going to be, well, we need to make sure we're budgeting for the increased salaries and employers NI in the forecasts like we mentioned, and also there's that final point about the VAT registered entities in your structure, in your businesses. Just make sure they're registered for MTD, and also using some software to submit the VAT returns. So with that, we'd like to open the floor now for questions. If you want to pop your questions in the question and answer box, and we'll cover them off. We've had a few come through already. So I think, just pulling it up here, there's one question earlier on, Jack, as to whether the personal savings allowance and starting rate were available to employees as well, as we were obviously discussing it in the context of director shareholders. Comment on that?
Yeah, simple answer is yes. They are just allowances available to any individual with taxable income. So yeah, employees, shareholders, directors, partners, all have access to those.
Yeah, it's good. It's quite a unique thing actually in the UK that, you know, right from the day you're born, you actually have those allowances available to you, don't you? Which is always useful to try and think about how to take advantage of that, which actually leads us on to the next question, which was, what is the tax-free allowances for children or grandchildren that aren't earning? So exactly the same as we've gone through today. Those, the personal allowance, savings allowances, dividend allowance, they all apply from, you know, as I say, from the moment you're born, basically. So again, it might be worth thinking about how to utilize those, obviously in a legitimate way. And this also brings us on to the third question, which is around a similar idea as to many may be aware of our sort of welfare trust or family well-being trust solution, which allows support to children and grandchildren in those categories. And it is the same answer really as to, there's the allowances we've gone through today. And the question also was, does this need to be done before the 5th of April? Well, yes, if again, it's like Jack mentioned, if those allowances aren't used before the 5th of April, they will be gone for this year, and you start with a new set next tax year. So be worth looking at that if that's applicable to you. So I hope that makes sense on those questions. Some more coming through. There's one question here, Jack, I don't know if you can help clarify on this. So talking about staff that are maybe into higher rates of tax. Okay, so I'm assuming this question is meaning that they're obviously earning over £50,000 into higher rates of tax. And it's about the savings rates that you mentioned earlier. I don't know if you want to just clarify on that.
Yeah, so if they're earning above £50,270, then they'll obviously have access to that personal savings allowance, and that is the same. Obviously, in reality, depending on the amount of funds they've got and any bank interest they've got, at the moment with the interest rates being so low, they might not be getting anywhere near that. The company, if I think possibly behind this question, the company could pay them interest if they loan the company money. So if an employee loaned the company money, they could give them an interest rate on that. Again, it would need to be a market rate of interest. You can't pay sort of extortionate rates of interest. And at the end of the day, the employee's got to be comfortable with loaning that money. It is an unsecured loan.
Yeah, that's good. Thanks, Jack. That's clear. Another question that's come up is relating to home working. and the tax concessions that are available for home working. I guess that's another sort of set of allowances that's available. Have you got any words of wisdom on that, Jack?
Yeah, no, that is different. So it was tightened up fairly recently. So there is some allowance. It's not very big, but the key thing is that's only available where you have to work from home. So in previous years, since COVID came in, you could claim that if you worked from home at some point, whereas now it's only if you have to work from home, if you're not able to work from the office, kind of thing. So it's been closed down to a certain extent, but it's still available for those that do have to.
Yeah, and I guess with the overall potential sort of transitions we're seeing across the board to sort of more hybrid options for home and office working, well, we'll wait for HMRC to catch up on that, and there could be some announcements in the spring statement or further on down the line in the budget later in the year on that front. We don't know, but it could be. So just having a look what other questions there were. There was just another question here. Can you recap on the maximum amount we can give to our children without inheritance tax? Was it 3,000 or something was mentioned regarding 12,000? I don't know if you want to just explain that again, Jack.
Yeah, sure. Yeah, so that's the £3,000 is an annual exemption. So each person can make that payment to their children or whatever per year. Now, the reason it came to 12,000 is because you can carry that forward for up to 1 year. So one individual can then make payment. If they didn't use last year's exempt allowance, they can pay £6,000. So and that is available per person. So that's why we're talking about £12,000 for a couple. So a couple could each give £6,000 using last year's allowance and this year's.
Yeah, so it's a kind of a technical point, but it's actually quite a useful one if you haven't used those allowances. There is a bit of flexibility there as to how you can do that. So yeah, I think that's good to know. So just having a look what other questions are. Another one is relating to employee contributions to a charity qualifying for tax deductions if reported to HMRC. Yeah, I'm just trying to get the context of that question. I suppose what they're saying is if the income is over £50,000, will those donations, will they get tax relief? Well, they've basically answered answered their own question. If it is reported to HMRC, then yes, basically. The point we were making is that if you don't actually report to HMRC, because if you think about it, if I'm making a bank transfer or standing order to a charity every month or whatever, if I'm an employee and if I was earning over £50,000, then I wouldn't be getting any extra additional tax benefit unless I contacted HMRC and informed them of what donations I'd made during this tax year, or if I do a tax return. So hopefully that makes sense, that it's only if we report it that they actually do it. Now, in this context as well, whether they're talking about payroll giving. So in payroll giving, where that can be done as employee, which sometimes happens, then the tax relief does kind of kick in, doesn't it, through the virtue of the payroll and the workings of the PAYE system. So through payroll giving, it will probably kick in. But if you don't do it payroll giving and you do it as a standing order personally as an employee, then yes, you'll need to inform HMRC. Another question relating to the tax figure on, your figure you mentioned earlier when you're doing that structure of income, Jack, with the small salary and then the dividends, and we arrived at a tax figure of just over 5,000.
Yeah, that's fine. So the way that's made up, so for each individual, you've got total income of £50,270. They get the first £12,570 personal allowance tax free. They then get £2,000 dividend allowance tax-free. Then the remaining 35,700 is then taxed, because that's dividends, that's taxed at 7.5%. So that's just under £2,700 per person. So for a couple, just short of £5,400.
Good, no, thanks. So hopefully that makes sense. And it's like you say, that's the whole point really, is if we can think about how we can structure the shares. And I think another question is how to declare different levels of dividends to spouses, maybe if there is different situations, personal income. And I think the answer to that one, obviously, we need to be careful how we do that, and there are settlements issues to be think about. But if the share structure is set up correctly, it's about utilising those allowances, and if we can do that, then the tax rates are pretty low actually, as it stands at the moment on that sort of remuneration structure. So it gets more into your hands. Personally, the other thing about the share side of things and how they're set up is just making sure that they're set up correctly so that you don't lose any what used to be called entrepreneurs relief, now called business asset disposal relief. So it's a technical point, but it's very, very important that the share structure of your company is set up right to make sure that you don't fall foul on those points. The other question, Jack, is on this loan account side of things, is interest rates we talked about. Can you backdate it? So if I want to do interest back from the beginning of previous tax year or beginning of this tax year, can I do that?
Simple answer is no. In reality, you need to come up with a loan agreement that would be effective from the date that it's signed. So you can only charge interest from that date onwards, really.
Good. I think that covers off on key questions. I'd like to thank everyone very much for joining this morning. As we'll say, we'll send around the link for the next event following by email, and there'll also be a recording of this event available too. So we'd like to thank everyone very much for their time. Our contact details are on the slide there if you need us. If you've got any further questions or we can help in any way, please reach out to us. Thank you and good morning.